Tensions between the US and China have reached a new high, with both nations locked in a complex and escalating standoff that has global markets on edge. The world is watching as the two economic superpowers navigate a relationship fraught with suspicion, competition, and the ever-present risk of miscalculation. At the heart of the latest dispute is the value of China's currency, the yuan, and the growing fear in Washington that Beijing may be tempted to use it as a tool in the ongoing trade war. In a move that underscores the seriousness of the situation, Washington has issued a stark and public warning to Beijing: do not devalue the yuan. This message, delivered at the highest levels of government, signals a new phase in the economic rivalry between the two countries. US officials are concerned that a weaker yuan would give Chinese exports an unfair advantage, further widening the already significant trade imbalance and putting American jobs at risk. US Treasury Secretary Scott Bessent's message in April 2025 was unambiguous: China must not use its currency as a weapon in the ongoing trade war. Speaking at a press conference in Washington, Bessent emphasized that any attempt by Beijing to manipulate the yuan would be met with swift and severe consequences from the United States. The Treasury's official statement left little room for doubt. The U.S. is prepared to act decisively to protect its economic interests. The U.S. insists that currency values should be determined by open and transparent markets, not artificially manipulated for competitive advantage. American officials argue that when countries intervene in currency markets, it distorts global trade, undermines trust, and can trigger a dangerous cycle of retaliation. The stakes are high, not just for the US and China but for the entire global economy. Bessent warned that any further devaluation of the yuan would be interpreted as a hostile act, one that could provoke even harsher American retaliation. This could include new tariffs, sanctions, or other punitive measures designed to pressure Beijing into compliance. The message is clear: the US will not tolerate what it sees as unfair currency practices and is willing to escalate the conflict if necessary. At the same time, the US is urging China to act as a responsible global partner. Washington wants Beijing to maintain a stable currency, adhere to international rules, and contribute to a fair and predictable global financial system. Diplomatic efforts continue behind the scenes, with both sides seeking to avoid a full-blown economic confrontation that could have far-reaching consequences. If China chooses to manipulate the yuan, it risks undermining its own ambitions for global financial credibility. A stable and trustworthy currency is essential for China's goal of making the yuan a major player in international finance. Any perception of manipulation could drive away investors, weaken confidence, and set back years of progress in opening up China's markets to the world. The warning from Washington is both a threat and a reminder. China stands to lose much if it continues down this path. The world's eyes are on Beijing's next move, as the delicate balance between cooperation and confrontation hangs in the balance. The outcome will shape not only the future of US-China relations, but the stability of the global economy for years to come. Why is the US so concerned about currency manipulation? When China weakens the yuan, its exports become cheaper, hurting American businesses and workers. This practice, the US argues, creates an unfair trade imbalance and undermines free market principles. If unchecked, it could trigger a global race to devalue currencies, destabilizing economies worldwide. The Treasury Department monitors such practices to protect American interests and ensure fair competition. Recent warnings to China reflect a long-standing US policy: defend the rules-based global economy. For Washington, this isn't just about trade, it's about upholding the integrity of the international financial system. Pressuring China to let the yuan float freely is seen as essential for global stability. China hasn't stayed silent, it's begun selling off its massive US Treasury bond holdings. This move signals Beijing's displeasure and wields financial leverage, potentially raising US borrowing costs. Ironically, selling treasuries should strengthen the yuan, contradicting US claims of Chinese devaluation. China's actions reveal a complex strategy, create market instability, and remind the US of its financial power. US officials downplay the impact, calling it a normal market correction, but the risk of disruption is real. China's use of its treasury holdings as a bargaining chip adds a new layer of unpredictability to the conflict. The financial chess match between the two giants is escalating. This currency dispute is just the latest battle in a broader, ongoing trade war that has been simmering for years. What began as a series of policy disagreements has now escalated into a global standoff, with economic consequences that reach far beyond the original players. The world is watching as two of the largest economies on the planet, each with their own interests and strategies, clash on the international stage, setting the tone for a new era of economic rivalry. Even before taking office, President Trump made it clear that he intended to shake up the global trading system. He pledged sweeping tariffs on all imports, with a particular focus on goods coming from China, which he accused of unfair trade practices and currency manipulation. These promises were not just campaign rhetoric. They signaled a dramatic shift in U.S. trade policy, one that would soon send shockwaves through international markets and unsettle long-standing alliances. China, in turn, was quick to respond. Anticipating the economic impact of U.S. tariffs, Chinese officials began planning to weaken the yuan, hoping to make their exports more competitive and cushion the blow to their economy. Behind closed doors, economists and policymakers strategized for a major economic clash, preparing for a scenario where both sides would dig in their heels and refuse to back down. In 2025, the U.S. followed through on its threats, imposing a new wave of tariffs that targeted a wide range of Chinese goods. China retaliated swiftly, introducing even steeper tariffs of its own, this time zeroing in on key American industries like agriculture, technology, and manufacturing. The tit-for-tat measures led to real-world consequences. Factories closed, jobs were lost, and supply chains were thrown into chaos on both sides of the Pacific. The escalating conflict didn't just affect the US and China. Other major players like the European Union soon found themselves caught in the crossfire. The EU imposed its own tariffs, seeking to protect its industries and assert its influence in the shifting global order. As more countries joined the fray, the trade war expanded, creating a tangled web of tariffs, regulations, and retaliatory measures that complicated international commerce. The result has been a multi-front trade dispute that shows no signs of slowing down. Global uncertainty has risen sharply, with stock markets experiencing wild swings and investors growing increasingly anxious about the future. The once stable trading system that underpinned decades of economic growth now appears fractured, as countries scramble to adapt to the new reality. Each move in this high-stakes game pushes the US and China further apart, making any hope of a quick resolution seem more distant. Diplomatic efforts have stalled, and trust between the two superpowers has eroded, leaving the world to wonder how and when this standoff might end. Today, tariffs and currency moves don't just reflect economic policy, they define the global economic landscape. As nations navigate this new era of uncertainty, the choices made now will shape the future of international trade for years to come. Key U.S. officials have set the tone for this confrontation. Peter Navarro, a hardliner, threatened immediate tariffs if China manipulated its currency, signaling a new era of aggressive action. Beijing dismissed these claims, but the stage was set for conflict. Treasury Secretary Bessent, meanwhile, focused on market stability and international rules, warning that currency devaluation would hurt everyone, including China. Bessent also highlighted the contradiction in China's actions. Selling U.S. bonds should strengthen, not weaken, the yuan. The administration's dual approach, threats and calls for stability, aims to pressure China while managing market fallout. This strategy marks a sharp break from previous U.S. policies. The US-China conflict has sent shockwaves through global markets, creating a ripple effect that extends far beyond the borders of these two economic giants. Investors, policymakers, and business leaders around the world are watching closely, as every new development in the dispute seems to trigger immediate reactions in financial centers from New York to Shanghai. US Treasury yields have swung wildly, reflecting investor anxiety about the trade war's impact. The uncertainty has made it difficult for analysts to predict future trends, and many investors are seeking safer assets, driving up demand for government bonds even as their yields fluctuate. This volatility is a clear sign of the nervousness gripping the markets. China's bond sales and US tariff threats fuel volatility, with stock and currency markets reacting to every development. Each new announcement, whether it's a fresh round of tariffs or a major bond sale, can send prices soaring or plummeting within minutes. The interconnectedness of today's markets means that even small policy changes can have outsized effects. The dollar has strengthened against the yuan but weakened against the yen and euro as other global factors come into play. Currency traders are constantly recalibrating their strategies, trying to anticipate the next move in a landscape that is shifting almost daily. The foreign exchange market has become a battleground for competing economic interests. Japan's growth and Europe's increased defense spending have shifted currency dynamics. As Japan posts stronger economic numbers and Europe responds to new security challenges, their currencies have gained ground, adding another layer of complexity to the global financial picture. These shifts are not just numbers on a screen, they reflect real changes in economic priorities and geopolitical realities. The uncertainty is chilling business investment worldwide, as companies hesitate to plan for the future. Boardrooms are filled with concern, as executives weigh the risks of expansion or new projects. Many manufacturers have slowed production, worried that sudden changes in tariffs or regulations could upend their supply chains overnight. This dispute is now a global problem, slowing economic growth and shaking confidence. International trade flows have been disrupted, and global summits are dominated by discussions of how to manage the fallout. The effects are being felt in every corner of the world, from emerging markets to established economies. The market turmoil is a symptom of deeper instability. Beneath the surface, there are growing concerns about the long-term health of the global economy, as leaders struggle to find solutions and restore a sense of stability in an increasingly unpredictable world. The trade war's impact is felt on Main Street, not just in government halls. Tariffs mean higher prices for everyday goods from electronics to clothing, squeezing family budgets. American farmers and manufacturers face lost sales as China retaliates, threatening jobs and incomes. Market volatility affects retirement savings and raises borrowing costs for homes and businesses. Economic uncertainty makes people spend less, risking a broader slowdown or recession. The conflict's ripple effects touch every household, shaping financial security and job prospects. What starts as a policy dispute ends up hitting wallets across the country. The stakes are personal for millions of families. This isn't the first time major economies have clashed over trade and currency. In the 1980s, the US pressured Japan to let the yen rise, leading to economic turmoil and a lost decade for Japan. More recently, the Trump administration labeled China a currency manipulator, sparking rounds of tariffs. These episodes show that forced currency shifts and trade wars have unpredictable, often damaging consequences. The current conflict is a continuation and escalation of past disputes. History warns that such battles are easy to start but hard to end without collateral damage. The lessons are clear. Blunt tools like tariffs and currency pressure can backfire. The US wants China to let the yuan float lower trade barriers and buy more American goods. If the standoff continues, the risks are severe, deeper trade war, global recession, and destabilized markets. The fallout could extend beyond economics, raising geopolitical tensions worldwide. The US and China drive the global economy. When they clash, everyone feels it. The choices made now will shape prosperity and security for years to come. One path leads to compromise and stability, the other, to deeper conflict and uncertainty. The world is watching as Washington and Beijing decide which way to go. The outcome will affect us all.